Good morning, students. This is the 10th class of insurance claim, and this is the 11th class, rather. This is the third class of loss of profit. So, I hope today is the last class of insurance claim. From my next class onwards, I'll start consignment, a new chapter. So, before going through the new chapter, today I will solve one sum regarding loss of profit, which I have already provided you in the PDF. If you go through that, the sum, it says that a fire broke out on 1st of July 2014 in the factory A Limited, and the business was practically disorganized up to November 30th, 2014. Business was completely disorganized. From the books of accounts, the following information was extracted. Actual turnover from 1714 to 30/11/14 means 30th November up to 30th November. From 1st of July, it is 3 lakh. Turnover from 1st of July to 30th November of the previous year, that is the standard turnover, 10 lakh. Net profit for the last financial year is 4 lakh 50. Insured standing charges for the last financial year is 3 lakh. Turnover for the last financial year is the total turnover which is 25 lakh, and turnover for the year ended on June 30th 2014 is 27 lakh 50,000, and total standing charges means insured standing charges has been included in the total standing charges, which is obviously in the year 2013 3 lakh 60,000. The company incurred additional expenses amounting to rupees 45,000, which reduced the loss in the turnover. Company has been incurring 45,000, which is the additional expenses, which basically reduce the loss in the turnover. There were also a saving during the indemnity period of 12,430 while preparing the loss of claim. That saving amount should be deducted 12,430 while calculating the gross claim. Whatever I have done in my previous class, it's more or less the same. The company holds a loss of profit policy for rupees 8,25,000, having an indemnity period for 6 months. The policy value is 8,25,000, indemnity period is 6 months. There had been a considerable increase in trade, and it has been agreed that an adjustment of 20% is to be made in respect of upward trend turnover compute claim under loss of profit policy. So we need to calculate that claim, as there has been given additional expense amount. We need to calculate that step, which is admissible additional expenses, list of the following means 3 1 2 3. That step we need to calculate over here, which was not there in the previous sum. That is why I have chosen this sum particularly. So first is obviously calculation of GP. It is illustration 6 in my book and in your PDF. First of all, which is working note number 1, calculation of GP rate. So this is the solution, right? This is the solution, right? Okay. Net profit for the financial year has been given. Net profit for the financial year has been provided. It is 4,50,000. Okay, it's been given in the sum, and insured standing charges has to be added up. Add insured standing charges, which is given as 3 lakh. So insured GP is basically 7,50,000. Now you have to see whether what is the sales. Sales for the year FY is financial year is given. The total sales means turnover for the last financial year, which is 25 lakh, right? And we all know rate of GP is net profit plus insure standing charges divided by sales into 100, right? Which is 7,50,000 by sales is 25 lakh into 100. So it is coming 30%. So GP rate is 30%. Now we have to calculate short sales, which is working note number 2. Calculation of short sales, right? We all know standard turnover less actual turnover. If there is any trend which is upward, it has to be added. If there is any trend downward, it has to be deducted, right? Standard turnover has been given, right, from 1st July 13 to 30th November 13, which is given 10 lakh. Turnover from 1/7/13 to 30/11/13, 10 lakh. As there has been upward trend, right, 20%. So 20% of 10 lakh upward trend, 20% of rupees 10 lakh, it's obviously 2 lakh. It is coming 12 lakh. And actual turnover, you have to deduct that. Actual turnover, which is from 1/7/14 to 30th November 14, which is given 3 lakh, right? Means 9 lakh is your short sales. 9 lakh is basically short sales. This is working note number 2. Now coming to working note number 3, which is GP lost on short sales. GP loss on short sales. Short sales into rate of GP. You know the formula. Into rate of GP. It is basically given short sales is rupees 9 lakh and rate of GP is 30%. Is basically it is coming 2,70,000, right? 2,70,000, right? Okay. Next, it is now as admissible expenses, additional expenses is there, so we need to calculate that step. Working note number 4, calculation for admissible additional expenses. You know what thing you have to calculate? Least of the following. Least of the following. Number 1, actual additional expenses. Actual additional expenses, which is given as 45,000, right? Number 2 is sales due to additional expenses, which is enhanced sale. Enhanced sales means uh, enhanced sales means the actual turnover actually. Enhanced sales means the actual turnover. Okay. Enhanced sales means actual turnover, or sales due to additional expenses is basically the actual turnover into GP rate, right? Sales due to additional expenses multiplied by rate of GP, which is basically the actual turnovers into GP rate is 30%. It is coming 90,000. And number 3 is actual additional expenses. Actual additional expenses multiplied by net profit plus insured standing charges. Net profit plus insured standing charges divided by net profit plus all standing charges, right? Net profit plus insured standing charges divided by net profit plus all standing charges. So actual additional expenses is 45,000 into net profit plus insured standing charges. Net profit is 4,50,000 plus insured standing charges is 3 lakh. So here also 4,50,000 plus all standing charges is 3,60,000, right? So 45,000 into 7,50,000 divided by 7,437, 7 lakh, 8,10,000. So it is coming 41,666, means 41,667. So least of the following means, in this case, therefore admissible additional expense will be rupees 41,667, because it is the least of the following. With these three, it is the least, so I will consider 41,667 as the least. So it is the admissible additional expenses in working note 4. Now we have to see whether it is applicable in case of or not, in case of average clause or not. So working note 5, applicability of average clause. Insurable value, you have to calculate. Insurable value is equal to adjusted annual turnover into GP rate. Adjusted annual turnover into GP rate. Adjusted annual turnover is given in the sum, which is turnover for the year ended June 30, 2014. It's 27,50,000. 27,50,000, and there has been an upward trend of 20%. So this amount has been upward trend of 20%, means 120%. And basically the why, because here there has been a trend in the upward dimension, which is 20% upward. So here also the turnover has to be 20% upward on 100, that is why it is 120%, and the GP rate is given as 30%. So while calculating this, it is coming 9,90,000, and we know policy value is given rupees 8,25,000, which is given in the sum. So here also IV PV is lesser than IV under insurance, and hence average clause is applicable. Okay, average clause will be applicable. Now coming to the sum, just keep in mind short sales is 9 lakh and GP lost on short sales is 2,70,000. I have to rub that, otherwise it cannot be done properly. Okay, right. Statement, this is the main part of the sum. Statement showing loss of profit. Okay, GP lost on short sales, it's short sales, which is working note 3, it's 9 lakh, right? GP lost on short sales, sorry, 2,70,000, working note 3, right? 2,70,000, because short sales is 9 lakh, right? Add admissible additional expenses, which is 41,666. Admissible additional expenses, working note 4, 41,667. Three lakh 11,667 less savings in standing charges, which is given 12,430 in this sum. Savings in standing charges, right, which is 12,430. If you deduct that, 2,99,237 is gross claim. Right? This is your gross claim. And now you need to calculate net claim. Right? Now the net claim. Therefore, net claim is equal to gross claim into policy value by insurable value. Gross claim is 2,99,237. Policy value is given in the sum 8,25,000. and insurable value you computed 9,90,000, right? If you calculate that, you will get 2,49,364, which is also approx, which is also in approx. Okay, so this is the sum. This is the net claim you will be getting from this sum. I hope you understand this sum. This is the last class, so I will not further linger this chapter again. From my next class onwards, I'll start with a new chapter, which is consignment. Thank you for this class, for patient hearing. Have a nice day ahead. Thank you very much.